Welcome to the last and fourth part of the Quant Crash course, where we look at and review concepts in limit management. Earlier in the course or module on capital management, we'd visited this sheet. On this sheet, you can see that there are two types of limits. There are transaction-driven limits and there are expectation-driven limits. Transaction limits start with loss capital and end at stop loss. Expectation-driven limits start with expected loss and end value at risk. Our hope is that by the time we finish this module, we'll be able to provide you with the link between stop loss and value at risk and share at least one instance of how these two limits can work together to create more value within the risk and portfolio management function. If you start with limit management, the most common limit that you're going to see as part of your work as a treasury, risk, or investment management professional are what we call counterparty limits. After counterparty limits come transaction and exposure limits. The idea behind these two limits is to ensure that we restrict the amount of exposure any one given individual can take on behalf of the bank. Next in line are sensitivity. So what happens to our numbers, to our P&L, to our balance sheet, to our exposure when interest rates go up or come down, when volatility goes up or comes down, when exchange rates go up or come down. And collectively, when we look at all four of these pieces together, we call or we name this as the limit management framework. So counterparty limits, transaction limits, exposure limits, and sensitivity limits. These four are the primary pieces of the limit management framework that we are going to review as part of this module. Let's start with counterparty limits. Now, while limits are there at a very, very high level, the specific limit that we will work with is a limit that deals with what happens when a counterparty fails to deliver or fails to meet the expectations and obligations that they've agreed to earlier. The most likely scenario is that you've agreed to buy or sell something at a future date. You've agreed to buy and sell it on a price that you've agreed upon today. The simplest example is that of a forward contract. You've decided to buy an amount of currency, you've decided to buy or sell a bond, you've decided to buy or sell an equity security. And on settlement date, the counterparty involved defaults. It cannot deliver for whatever reasons. So now the question is that if the counterparty is not delivering, the only way that you can fill that order, that you can close that position, is buying from the market. And if you buy at the market, you would buy at the market price. You would not buy at the price that you'd agreed upon at some point in time in the past. So from a counterparty point of view, a PSR or a pre-settlement risk limit basically tries and calculates what is your overall credit exposure to a counterparty if that counterparty defaults. And is that exposure within your regular limits or not? So we take a look at a very simple example. We take a look at the PSR or pre-settlement risk limit involved or required or utilized for a forward bond transaction. So what you're trying to do is you're buying $100 million worth of the 10-year bond. Let's say the yield to maturity on that bond is about 8%. The price is about 104. The rate volatility, so the underlying rate volatility for the 10-year rate is about 1.17%. The duration of the bond is about 6.8. Now, based on the value at risk framework that we had presented earlier, what you're really saying here, you're saying, look, if rates go up or come down, we are likely to see a movement of up to 0.6757%. So if rates right now are at 8.36%, if they go up, they may go up as high as 9% and change. If they come down, they may come down as low as 7.67% and change. And the expectation for this movement is over the next 30 days. So the question is, what are you worried about? What are you doing? You are buying a bond, right? You're buying a bond in the forward market, which basically means that you will buy this bond at the end of 30 days from this counterparty. The price that you've agreed upon for this bond is, let's say, 104. So what is your exposure? Your exposure is, if rates go up, what happens to the value of the bond? Bond is worth less. You agreed to buy it at 104, it is now worth less. Do you have an incentive to default? Yes. Does the counterparty have an incentive to default? No. So if rates go up and you're buying a bond, you're not worried about counterparty default. You're worried about your default, or the counterparty is worried about your default. What you're really worried about is the instance when rates come down and the bond becomes more valuable. Now, how valuable could it become? If you look at the numbers below, where we say VAR percent 8.609, and you look at VAR US dollar about 8.98, we're saying is this bond, for assuming a notional of 100 million, could become valuable by 8.98 million US dollars. So if rates actually decline from 8.36 to 7.67 or change, whatever that number is, when we subtract 0.6757% from it, this portfolio of $100 million in the 10-year bond would become valuable by about $8.98 million. And that's our exposure. Because if the counterparty defaults and says, I can't deliver this bond for whatever reason, then you have to buy this bond from the market. However, you will no longer be able to buy it at 104. You'll actually end up buying it for 104 plus 8.98 or change, which basically means that you would be out of pocket that amount. So from a credit exposure point of view, from a default point of view, what is the limit that you need? When it comes to doing this trade or this transaction with this counterparty, is your limit 100 million? At a notional level, yes. At a gross level, yes. But from a PSR point of view, the limit that you want for this transaction is not 100 million. The limit that you want for this bond, for this transaction, is 8.98 million US dollars. Now, assuming that the counterparty actually has this limit, and you've allocated the PSR limit to 8.98, what does this mean? This means that somewhere in the bank there is a function that looks at limit allocation for a client or a counterparty, and then also moves ahead to ensure that that limit is secure. Whether that limit is secured by a guarantee, by collateral, by margin, is up to them to decide. But when you say, I have a PSR limit utilization of $8.98 million, you're saying for this counterparty, when this counterparty does this transaction with me, from its available allocated limit that has been assigned, I will use 8.98 million US dollars. So I hope this example sort of clarifies the concept around PSR. Just to be safe, we will actually do two more examples around PSR. We've done one for the bond. We'll do one more for FX. So we take a look at the next example, which is the calculation of PSR for a forward FX transaction. Nothing has changed. We're still looking at the same notional of 100 million. The forward time frame is now 1 year. The rate is 5. What we're saying is, a year down the road, we will buy 100 million euros at a price of 5 dirhams per euro. So I'll pay 500 million and I'll get 100 million euros. Now the question is, what's the worst case movement? In this specific case, the worst case movement is 8%. So that means that the 5 dirhams per euro rate can go from 5 to 5.4 or 4.6. And in both instances, so in the first instance, you will pay 500 million for something which is worth 540. In the second instance, you will pay 500 million for something which is worth 460. Where's the risk? From the counterparty's point of view, there is a risk that you will not pay 500 million for something which is worth 460. From your point of view, there is a risk that the counterparty will not accept 500 million for something which is worth 540. Right? So in both cases, the rate shock in question is 0.4. On the notional that we looked at, you're saying in dirham terms, the value at risk is about 40 million, which is 8% of 500 million. The PSR limit utilization also in dirham terms is about 40 million dirhams. So from a counterparty point of view, I have a gross notional limit of 100 million euros or 500 million dirhams. I also have a PSR limit or a pre-settlement risk limit of 40 million. That's the limit that has been utilized for this specific transaction for this specific customer. And then I'll also have a total or a maximum PSR or pre-settlement risk limit, which would then give me an indication of what's my overall PSR exposure to this specific counterparty and this specific customer. A third and quick example, this time rather than looking at bonds and FX, we're looking at equity. You're buying a share of FedEx, you're buying $100 million dollars worth of FedEx shares. Let's say the FedEx share is trading at $100 a share right now. You've agreed to buy this 3 months down the road, assuming a fairly generous rate. Let's say that the future price for this is set at 103. The volatility in FedEx is 15%. So the expectation on let's say this is for the time frame in question, which is 3 months. The expectation from our point of view is that your value at risk number, your worst case loss number, is about 35%. So the expectation is the $100 would be worth 135, or it could be just as well be worth 65, and that's the risk. So what you've done is you've agreed to buy FedEx 3 months down the road at a price of 103, irrespective of where the price is. The price could be 135, it could be 65. Your exposure or your counterparty's exposure is to that you will not perform if the price is not in your favor. And in that case, the PSR or the pre-settlement risk here also is 35 million or 35% of 100 million. So I hope these two examples, the bond, the currency, and the equity future contract example, has illustrated the concept of pre-settlement risk or PSR. We will come back to this later, right towards the end of the course, when we actually look at an example of PSR and PFE that we call potential future exposure. But just to take a step back, the PSR process starts with an estimation of volatility or vol. From vol, we calculate value at risk, which is a worst case loss. From VAR, we calculate a worst case move in dollar amount or dollar terms or currency terms. We then plug that into a pricing model. We then calculate the impact of a default if the counterparty fails to deliver or refuses to deliver or cannot deliver the contract or on its obligation, and that gives us our final PSR limit. That's the process. From vol to VAR, from VAR to worst case, from worst case to pricing model, from pricing model to default impact, from default impact to PSR. So the first type of limit that we saw were counterparty limits, and while there were gross counterparty limits, what we really focused on in the previous section was on pre-settlement risk, a different type of a counterparty limit. We now look at transaction and exposure limits. Now the objective of transaction and exposure limits is to ensure that an individual or a desk or a trader can only take on a limited amount of exposure with respect to the risk profile of a bank. So one trader, one individual by himself should not be able to sink the bank. And he can do that if and only if he has the tools or the limits necessary for him to take on unreasonable risk that the bank's capital cannot support. When you look at again transaction and exposure limits, you can see that these limits can be applied at a trade level, at a security level, at an operating cycle, so within a day, within a month, within a week, at a tenor and maturity bucket level, so up to 1 month, up to 3 months, up to 6 months, up to a year, up to 5 years, up to 10 years, or within a risk classification or grade for a given counterparty or a given security. So within a trade, the most likely example that you see for a transaction limit is maximum ticket size. What's the maximum that you as a dealer can book on a given ticket in a given day? Within a security, you can again see max product limit. So while the ticket size would say, as a trader, I can only buy at the max $100 million worth of bonds in a given day and $500 million worth of bond in total. So 100 million individual ticket level, 500 million total day activity level. Within a security, I can say, of that 500 million that I can buy in a given day, I can only buy 50 million of the 10-year bond, 100 million of the 5-year bond, 200 million of the 3-year bond, and whatever is left up to the maximum limit of T-bills or treasury bills with maturity of up to 1 year. So that's within a security. Within an operating cycle, what can I do within a day, within a week, within a month? Max daily limit is one example or one instance. Within a tenor or maturity bucket, so I can only buy 3 months, 6 months, or 1 year, or I can only buy X amount of the 5, 10, 15, 20, 30 year bonds. and then within a risk grade or a classification. So I can only book so much exposure to a given counterparty. I can only book so much exposure to a given volatility. I can only book so much exposure to a given security given its liquidity profile. All of these are examples of transaction and exposure limits. Now, there are other limits that, technically speaking, could possibly be called transaction and exposure limits. The first that comes to my mind is concentration limits. So what's the maximum exposure that you can take to a given trade, given security, given maturity, given tenor, or a given counterparty? The second are called inventory edge limits. So, how long at max can you keep a position? When you have to go out in the market and wash yourself, which basically means that you bring that position down to zero, and if you really, really like it, then you can recreate it. But what's the maximum that you can hold a position for? And the reason for inventory edge limit is primarily to ensure that traders do not sit on illiquid position without informing or without recording the fact that these positions are illiquid as part of their regular reporting cycle. The third type of limit that we're likely to see are sensitivity limits. And unlike transaction and exposure limits, the rule here, or the objective here, is to do something completely different. So now I'm saying the position is taken, you already have that. There's nothing that you can do about that. What you really want to track now is what happens to this position if rates go up or come down. When we say rates, both exchange rates and interest rates. What happens when volatility goes up or comes down? And then beyond the first three, how or what happens to my earnings potential based on this specific position when any of the above three happen? When rates go up or vol goes up and down, what happens to my earnings? Or what happens to shareholder value? Or what happens to equity or capital? So, what's the hit? What's the expected? What's the projected hit? If I were to go out and book a loss based on mark to market, if I were to expect that the vol shock that I'm projecting is realized, what happens to my earnings, my shareholder value, and my equity or capital? These are all sensitivity limits. A great example is the earning at risk report that we use on the asset liability management or the ALM side. Another great example is the market value of equity or NPV or shareholder value report that also we use on the ALM side. You can also look at maximum loss, worst case loss. On the exchange rate side, you look at changes in position based on price value of a given interest point. On the interest rate side, you look at duration, TVPP, caps, and interest rate mismatch. On the vol side, you look at vega, changes in value and changes in projected P&L, as well as gamma. Earnings side, we've already spoken about NII and earnings at risk report. On the shareholder side, we looked at market value of equity and PV reports. And on the equity and capital side, we just want to look at what happens to the overall surplus position of the bank or the desk if things go wrong. So to apply sensitivities to the example of the PSR or the pre-settlement risk for the forward bond that we looked at earlier, I'll simply ask one simple question. What happens when the volatility of the interest rate changes? So we've assumed the rate vol is at 1.179%. What happens if it goes to 2 or 3 or 4 or 5? And if vol changes, then obviously VAR changes, and if VAR changes, then my PSR limit, both utilization and exposure, also changes, right? And so this is one example or one instance of applying sensitivity to the limit structure. Second is what happens if interest rate change? Rates go up or come down by 50 basis points. So one is overall volatility is changing. Second is there is a central bank meeting or a Federal Reserve meeting or an FOMC meeting, and that meeting decides to rise, hike, or reduce rates. So what happens to your YTM? What happens to your VAR? What happens to your PSR? Change in term structure. So short-term rates go up or down, long-term rates go up and down or go nowhere, mid-term rates go up and down or go nowhere. So the shape of the curve changes. What happens to your PSR there? Change in capital charge. Change in capital charge generally is linked to counterparty rating. So if there is a change in capital charge because there is a regulatory change, or there is a change in capital charge because the counterparty risk rating has changed, what happens to my PSR limit? So these are all instances or examples of applying sensitivities to a given transaction and to a given. The problem that you face, however, is that a typical bank, a large size bank, or an active bank or an active desk may as well as do 6,000 transactions in a month.
While it's nice to calculate PSR and sensitivities for all of them, what the board or the senior management team really wants to see is not this level of analysis at each of those transactions. What they want to see is overall aggregate numbers, one, both on a gross and net basis, and two, more importantly, they want to see exception. They want to see in areas or positions or factors or drivers or markets or business lines where there is a significant risk that they would lose either large amounts of capital with low or small probabilities, or even mid and reasonable amounts of capital with large probabilities. So if I were to look at the limit management framework, my first layer, as I presented earlier, was counterparty limits, both gross, net, and pre-settlement risk. My next layer was transaction and exposure limits. My third and final layer was sensitivity. And the idea is that when I combine all of these pieces together, I actually have a framework that I can work with. So this ends the first piece of our presentation. We now move on to a transaction limit, which we call a stop loss limit. And the rationale behind the stop loss limit is it's a safety valve. It's there to ensure that a desk, that a treasurer, that a trader does not lose beyond a certain amount when it comes to exposure. And the way that we enforce this is, if I've defined a stop loss limit of 5% or 10%, then the rationale is that if the loss on a specified position is more or less than this amount, then the stop loss limit would be triggered. And when that limit gets triggered, this position will be liquidated. I will book that loss. I will sell this position, eat that loss, and move on. And the rationale and the logic behind eating that loss and taking that loss and booking that loss is to ensure that my capital is secure, that the overall loss across the year is limited to the amount that was allocated initially and does not exceed that threshold. Now, the problem with soft loss limits, is that they come in two flavors. The first is what we call a hard limit. This is the limit that should not be beat. The second is what we call a soft limit. This is the limit that triggers. So the idea is, if I set a stop loss limit of 10% and I wait till that limit is breached, that by definition ensures that when I go out and liquidate my position in the market, I will certainly not be able to get out at 10%. There will be some slippage. Even if it's a few basis points, there will be some slippage. If it's a liquid market, a volatile market, an active market, a moving market, then the slippage may be even higher. So the reason or the rationale behind a soft limit is, if the hard limit is at 10%, the soft limit would be at 7.5, 8%. And what that means is, the minute 7.5, 8% is touched, the execution will go through for liquidation. Depending on how good and efficient my execution is and how volatile and active my market is, I may be able to get out at 8, 8.5, 9, 9.5, or even 10%. But that 2% margin is a margin of safety that ensures that the action that the soft limit triggers can get executed before the hard limit is reached. And this is the concept, or this is what we mean by slippage. Soft limit will slip. If your hard limit and soft limit are set at the same point, then there will certainly be slippage. The reason for separating this hard and soft limit is to ensure that slippage is minimized. So for the process of setting stop loss, you have to answer one simple question. What is the amount of capital you are willing to lose? That's the first question. Now, where does this comes from? Where does this capital comes from? Very, very simple, very, very plain example is that, let's say if I run a book of $1 billion and I expect to earn a return of 10% on that $1 billion. So $1 billion, 10%, $100 million in income over the year. Now my question is, what part of this am I willing to risk? So if I want to secure my capital, if I want to ensure that my investors and my shareholders are protected and at least get their principal back, I may set 50 million of this as stop loss capital. So I expect it's alright for me to lose this 50 million because this is coming from the return that I've generated. However, it also ensures that my investors get at least the 50 million or 5% return or yield on the amount that they have invested with me. Now this 50 million I can use to take on risks and bets and lose this money if there is a need,
but it ensures that my principal is protected and I earn and book and realize a minimum possible return. So that's an example of quickly linking loss capital with stop loss and book size. If I were to translate this into number, what I'm saying is if my stop loss or my loss capital amount is 50 million and my stop loss limit is set at 10%, then the maximum book size that I can earn or that I can create or set for my risk book, for my prop book, for my trading book is 500 million. And how I arrive at that number is simply 50 million divided by 10%. So the idea is that if I take 500 million and I invest that into, let's say, 10 positions of 50 million each, and I lose 10% on all of them, then the maximum that I can use, the maximum that I can lose is $50 million. And this obviously assumes that the stop loss limit, its compliance, its enforcement is done in such a fashion that on no position I end up losing more than 10%, which then basically means that from a capital point of view, max that I can lose is about 500 million. So we take a look at a quick example where we allocate this 500 million across 10 positions and we set the soft stop loss limit at 8%. Here's the example. There we go. So in this example, what we've done is we've taken that 500 million, which is the book size that we'd allocated once we allocated a stop loss capital of 50 million, 500 million. Sorry, 50 million divided by 10% is 500 million. So each book is about 50 million. So on each of these positions, I can afford to lose about 8%. And that 8% across these 10 positions is about 40 million. So my overall amount is 50 million. My soft loss amount is 40 million. The slippage that I'm allowed that I can work with is about 10 million. And right now, if I look at the structure, I can see that based on current prices, I have 1, 2, 3 positions that are negative, but all 3 of them are within the range, which means that I do not need to liquidate, cut, or exit my position at this point in time. So slippage, how would slippage come into play? If you assume that you set slippage at 10%, if you assume that you're only able to exit when the market gives you the exit, and even if you use the soft limit of 8%, there's a good chance that the actual number that you see, that you realize is going to be higher than 8%. So we look at the same 10 positions that we started off with earlier. However, in this case, what we're seeing is we're saying that we have 1, 2, 3, 4, 5, 6 positions where there is a problem. And these are indicated by the column that says stop loss decision. And the reason why we have a problem is that our gain loss on these positions is over 4 million. So our soft loss limit was set at 4 million. Gain loss is about 4 million. Loss is about -4, -5, then -4, then -6, then -4, and then -5. And I'm looking at the position I'm reading off are position number 1, 2, 3, 5, 6, and 8. Now, if you look at the percentage of book value, you can see that for the first, the execution gets you out at 8.36%. For the second, 10.45. For the third, 9.4. For the fifth, 12.5. For the sixth, 9.48. For the eighth, 10.6. And if you add this up, because you had that margin, because you had that margin of 2%, because you added this up, you're still above 10 million. So while slippage has happened, from a capital protection point of view, you've lost about on these 1, 2, 3, 4, 5, 6. On these 6 positions, you've lost about 30.46 million. On average, you were allowed 5. So on these 6, you've lost about 30. And as you see, despite the slippage on the 6, your overall slippage is still 460,000. All right. So that's the number that I'm reading from the bottom. That says 30.46 million. That's the overall loss. From a slippage point of view, slippage of 5 was allowed. So my overall excess slippage is about 460. All right. So if I look at the process starts with risk appetite. What's the amount of capital that you are willing to lose? And this gives me the loss capital amount. The second question is, what's my target stop loss limit? I set 10%, and I need to break this down between hard and soft. So my hard was 10%, my soft was 8. A third is book size. I take the loss capital divided by the target stop loss, and I get my book size, and then I can allocate this book size to individual products and individual positions. The last piece is the actual stop loss limit, and this is where I ensure that I factor in both volatility, likely slippage, liquidity or illiquidity in my market to ensure that the overall capital, the overall loss of capital that is realized is within the allocated limit. A natural question that comes up when you deal with stop loss and VAR is how are the two related, or is it possible to link the two? And this is a question because when you look at stop loss is a transaction based limit. If you go back to the diagram that we'd seen earlier, we'd mentioned that there are two types of limits. There are transaction limits and there are expectation limits. So stop loss is a transaction limit. Value interest is an expectation limit. How do we link the two between? So if you go back to the value at risk example, VAR is worst case loss over some time period or holding days with some minimum level of confidence. The way we link the two is we pick a VAR limit at a confidence level in such a fashion that the VAR limit times book size is equal to the stop loss limit times book size. So an example would help. If you see what I've done here is I've assumed that I have volatility of about 15.5%. My book size is 500 million. That's the number that I came up with initially. Now, what I'm looking for is I want to set my VAR limit using a confidence level in such a fashion that the VAR limit that I look at is close to or about or approximately the same as my stop loss limit. So in this case, if you look at the extreme right corner, you see the column called limit. Within that column, you see three numbers, 19, 52, and 180. If you look at the extreme left, you see three numbers, a column called odds. You see 2:3, 1:3, and 1:99. I'm saying is, there is at 60% confidence level, there is a 2:3 chance that I'd lose an amount more than 19 million. At 75% confidence level, there is a 1:3 chance that I'd lose an amount higher than 52 million. At a confidence level of 99%, there is a 1:99 chance that I'd lose an amount of higher than 180 million. So I'm not interested in the 60 percentile or the 99 percentile. What I'm really interested in is 75 percentile because that's where my stop loss limit meets and matches my value at risk limit. So what I want to do is I want to calibrate my stop loss and my VAR at inception. And what I've really done here is, go to the next example, is what I've done is that I've set the odd, I've accepted the odds that there is a 1:3 chance that I will see a loss of more than 52 million. There is a 3:1 chance that I'll see a loss of less than 52 million. And this corresponds to a confidence level of 75%. So remember, this is done at a vol of 15.5%. And my question to you now is, what happens when vol goes from 15.5% to 31%? What would you do? From a VAR point of view, it's very simple. VAR jumps immediately from 52 million to, let's say, 104 million. So now what do you do with your stop loss? If your hard limit is at 10%, and your soft limit is at 8%, and this happens, and both of them are linked and calibrated, what do? Do you increase your stop loss? So does stop loss become, you get a hard limit of 20% and a soft limit of 16%? Or do you do the other thing, which is you turn around and reduce your exposure and your hard limit becomes 5% and the soft limit becomes 4%? So the answer to this question is dependent on who you are and who your board is and whether you see vol as a threat or as an opportunity, whether you make money when vol is high or whether you make money when vol is low. And depending on what that profile is, most people though would go out and reduce limits from 10 and 8 to 5 and 4 in such a scenario when market volatility and VAR limits are go higher. And that's the linkage. That's the linkage that allows you to link value at risk, and stop loss together. That's the linkage that actually takes VAR as a signal for either flexing or reducing your stop loss levels. So the final question and the final piece when it comes to our limit management section is exceptions. When it comes to exception, what do you want to see? What do you want to report? If you have 6,000 positions, do you look at limits? Do you look at transactions? Do you look at exposures? Do you look at sensitivities for all of them? Do you look at them at aggregate? Do you generate 200 reports at 600 columns that go out to the 5 people at your board risk committee and the 10 people in your middle office and the 30 people in your front, back, and transaction and portfolio management team? The answer is no. I think at an exception level, what I really want to see are exceptions. At a reporting level, what I really want to see are exceptions. I don't want to see regular data or noise. I want to see, here's something that's gone wrong and needs your attention, rather than everything's running fine and normal and there are no problems. What you see in front of you are trailing volatilities. This is a concept that we introduced earlier in our course when we started working with volatilities. And the trailing vol here include volatilities for WTI, which is the green line, for Euro USD, which is the red line, and for gold, which is the blue line. Now, within the Euro USD line, you can see that there are instances where vol goes up. Right? For WTI, you can clearly see that there are one instance in 2005, one instance in 2008, 2009, and one instance in 2010 when vol significantly jumped. Right? Same thing with gold. Around about the same time that oil was going through ups and down, gold went through the same up and down. And then in 2006, 2007, and then again in early 2010. So what I want to see are these exceptions. What I want to see is the impact of these exceptions on my numbers, on my exposures, and on my sensitivities. And at a board level, what really matters is your ability to identify these exceptions and report these exceptions, rather than reporting all the data on an as-is and where-is basis. So one example that I really like is a control framework that was presented earlier by a friend of mine. And here what you see is the identification of an exception. So there is an overall trend that is given by the green line in the middle, and there is an upper and a lower barrier, and as soon as that barrier is touched and breached, you record, generate, and report an exception. That's what we mean by exception. In this case, this exception is every time gold crosses a volatility of, let's say, 2%, and WTI crosses a volatility of 3%, and Euro USD crosses a volatility of 1%. This is an indication that something in the market has changed that requires more of your attention, and you need to decide whether you want to reduce your position or increase your position. Second is a systemic degradation, where something just falls through the roof or the floor and stays there. Once again, this is an exception that needs to be recorded, identified, and reported. And in this specific instance, I think if any deviation that you see here that tells you that something is not right and is not right on a consistent basis. If you look at, for example, the spike that happened in WTI in 2005, compare that with the spike that happened in 2008, 2009, and the spike that happened in 2010, you can see that there's a big difference. The first and the last, the 2005 and 2010 one, are short spikes. The one in the end of 2008 is a long spike. It's a spike that is systemic in nature. It's just gone down. Once again, this requires you to decide whether what's happening is normal, for you to evaluate the impact on your numbers and your decision to whether pull out, reduce, or increase your exposure to the market. And the last and final one is increased volatility. And if I go back again, you can clearly see that there are numerous instances here where vol actually goes up and comes down, goes up and comes down on a regular basis. So we move on to the final part of our case, which is the PSR case, and we will take a very simple example to illustrate our understanding of pre-settlement risk, also introduce a new concept called PFE. So quick review, what is PSR? As we said earlier, pre-settlement risk could be applicable to a bond purchase that settles 2 days later, an FX forward transaction that settles within 30 to 90 days, or a cross-currency swap transaction that settles within 30 to 180 days. In short, I'm looking at worst case movement, counterparty default, and the impact of that default on my position. So the example or the case that I want to work with is called a cross-currency swap. And the rationale and the logic behind a cross-currency swap is that I have a currency pair. It could be Euro USD, could be AED Euro, could be GBP Yen, could be Australian dollar and Yen, could be PKR and USD. So it could be any combination. The idea is that I exchange the interest rate differential and I exchange the exchange rate differential. So on one end I receive the interest rate differential, on the other end I receive the exchange rate differential. And from a valuation point of view, I have two pair of rates. I have a local currency rate and I have a foreign currency rate. I have a credit spread, I have maturities, I have an amortization schedule, and I have exchange rates. And when I combine all of these, I get a model that gives me a value for my numbers. So now what you see an exposure trend that tells me that, as of 31st December, 30th June, 31st December, all the way from 09 to 014, here are the numbers, both from a mark-to-market and valuation point of view for my cross-currency swap. And when I start the year in 31st December 2009, I have a negative mark-to-market of 125 million. By the time I hit 2012, I have a positive mark-to-market of 51 million. My potential future exposure, the amount that I'm in the money, is given by the table that you see in front of you. If it's negative, that means I owe the counterparty something. If it's positive, that means that the counterparty owes me something. And the risk of default is when the counterparty owes you something, when the counterparty is in your debt and no longer has the incentive or the motivation to perform. So in addition to PSR, which is pre-settlement risk, in this case what you're looking at is PFE, which is potential future exposure. And as you can see, depending on who you are and which side of this transaction you are, your PFE could be 51 million positive or could be 125 million positive. So from the counterparty's point of view, the PFE is 125 million. That's at the start of the transaction. From my point of view, I'm sitting on the other side. The PFE is 51 million, and that happens right in the middle of the transaction. So a third limit that we look at, that we're likely to see within the financial services side, in addition to PSR, is PFE or potential future exposure. There you go. So you can see that this is the trend, this is the shape or the path that the mark-to-market on this structure, on this transaction will take over its life, starting from time 0 to maturity. And your PFE is the amount where this curve peaks out. Now you can take this analysis much further and you can evaluate the impact of the local currency shock and see how does that move when rates go up or come down. You can evaluate the impact of the foreign currency shock and decide where rates are and what will happen if they go up. You can look at exchange rate movements, both upwards or downwards. And the combination of all of these gives you some indication, some idea of what your sensitivities are to the factors that you just discussed. Local rates, foreign rates, exchange rates. So this completes our section on limit management. I hope that this has given you a brief introduction of the different types of limits you're likely to see in a treasury and risk function. We hope that we've been able to illustrate the difference in the way that we calculate PSR and PFE limits, as well as the linkage between stop loss and value at risk. Ultimately, a risk system is only as good as the limit enforcement mechanism in place. And now that the quant crash course is complete, we hope that you've now received a full review, starting from volatility to value at risk to stop loss and linking value at risk to the stop loss limit process. Thank you very much for your time. This is Jawad Ahmed Fareed for financetrainingcourse.com.